In brief exercise 18-13, we have a repossession of an item that was previously sold on the installment basis, and we used installment sales accounting. So the vendor's name is Lazaro, and Lazaro sells goods on the installment basis and uses the installment sales method. To reiterate, just because you have a sale that's on an installment basis does not mean that you use the installment sales method of accounting. That is appropriate only when there is significant uncertainty concerning the likelihood of collectability. We're told that due to a customer default, Lazaro repossessed merchandise that originally sold for $800. And at the time of the sale, we did the calculation and determined that the gross profit rate on this sale was 40%. At the time that we repossessed the property, the uncollected balance, that is the installment receivable due us from the customer, was $520. The fair value of the repossessed merchandise was $275, and we're asked to prepare the journal entry to record the repossession. Here's what the journal entry looks like. We're going to debit repossessed merchandise, which is in the inventory account, for $275. $275 is the fair market value of the repossessed merchandise. So the repossessed merchandise goes back into the accounting records of the selling company at fair market value. We're going to remove from the installment account receivable the balance that is due us from the customer that defaulted. In this case, we're told that the customer, the remaining amount due from this customer, was $520. So we're going to remove that balance from the installment account receivable account by crediting that account $520. Next, we're going to calculate the balance in the deferred profit account that is attributable to this receivable. And here's how we're going to do it. First, we're going to take the amount that remains to be paid us from the customer, the $520. Then we're going to multiply that times the gross profit rate, which we are told in the facts of the problem is 40%. And so the result of that calculation, 208, is the amount that is embedded in the deferred profit general ledger account that is attributable to this installment receivable. We're going to remove that balance from the deferred profit account by means of a debit entry to the deferred profit gross profit account. The difference between the installment receivable and the deferred profit account is essentially the net amount embedded in the company's balance sheet attributable to this sale. The difference between that amount, you can think of that as the net amount of the installment receivable. Again, net amount of the installment receivable for our purposes here is the balance in the receivable account less the related deferred profit. So the difference between the net amount of the installment receivable and the fair value of the merchandise that we got back is recognized as gain or loss on repossession. In this case, the difference, 520 minus 208, is the net carrying amount of the installment receivable. The fair value of the merchandise that we repossessed was 275, and the difference between those two amounts is the loss on the repossession, which is $37.